Bonjour à tous.
So hello everybody. Let's see, are the microphones working? I'm delighted to start the afternoon with a subject that is a real hot topic today, with political, social, financial, monetary consequences. How do we manage inflation? So inflation is a concept that we thought had disappeared. And it's suddenly come to the surface again over the past few months, and we will continue to hear about it. There'll be lots of debates about it by economists across the world. So I would like to thank our 5 guests. Now we'll just check whether the connection with China is working. And before introducing everybody, I'm going to hand over to Jean-Paul POLLIN, who is the coordinator of this session, and he will be giving us the outline and asking questions. Yes, thank you very much, Béatrice. So this isn't a scoop. Inflation is back in most advanced countries. So the thing that's more surprising is that it comes and goes when you expect it least. You know, we have several decades of moderation, and since 2012 in Europe, inflation was below 2%. In other words, it was low in relation to the objectives set, notably the objectives of central banks. So we were worried about that situation. We were so worried that when the health crisis came along, we were afraid of deflation because this is a terrible thing, according to economists. And because we thought that deflation would rear its ugly head, we focused so much on stimulating economies using budgetary policies, but also monetary policies. And yet, one might wonder whether it wasn't possible to foresee that this contracted supply, because of disruptions in production processes due to the health crisis, notably due to lockdowns, together with a higher demand through monetary and budgetary means, one might have wondered whether this wasn't going to lead to an increase in rates. So, you know, was it as surprising as all that? So we're not there yet. The increase in prices, it's not inflation. Inflation, you know, in academic circles, we define it as an increase, a general increase in price levels that is kept up. And for this to happen, you have to have this terrible race, a price race, you know, prices of products at all stages of the production process. And then you have that famous spiral, price and salary. And those are the secondary effects. So for inflation to settle, you have to have a distribution conflict somewhere. So starting with that idea, well, it can actually help us to understand the solutions that may be used in order to manage or better control inflation. Now, we know lots of these solutions. There's the solution that consists in orchestrating a hardening of economic policies in order to reduce or get rid of market power of some entities in the circle. But we do this at the price of a reduction in economic activity and a reduction in employment. And there are other solutions. The state, for example, could take on part of the increase in prices. It could cover, and that seems to be the wish in France. However, the underside of that is that it has a big impact on the state budget, and that's costly for the balance of public economics. Or we can control prices. Now, this reminds me of my youth. Of course, we have to understand that any control leads to rationing phenomena and inefficiency phenomena in particular. So then you have the income policy that was used in many countries, as much in the UK as in the United States, as in France. This income policy consisted in bringing social, there was a social dialogue about salary levels. But this social dialogue has to exist, and we have to have the right conditions for good social dialogue. We have to have all of those conditions brought together. So that's all well and good. But at the end of the day, wouldn't a better solution shouldn't it be quite different from what we've heard? Place economies on a higher growth path. In other words, having a higher growth, more sustainable growth, guaranteeing an increase in overall income that can then be distributed, and something that would help with the distribution conflict that I was referring to earlier on. So this is all to be done. It's about structural policies, not just policies based on the economic climate. It's not a problem of supply. It's a problem of supply rather than demand. But the work is ahead of us. The work to focusing on solutions, and hopefully, the debate will bring in solutions to these different questions.
Jean-Paul.
Thank you very much, Jean-Paul. So, you've launched some questions. So, let's have a look at who we have for the debate. Of course, we can't have a debate like this without Mr. Trichet. Thank you very much, former president of the European Central Bank. Next to you, we have Luiz PEREIRA de SILVA. You are General Assistant Manager of the Bank of International Settlements. Thank you very much. We also have Jean-Béatrice, your President of the Board of Directors of HSBC Continental Europe. Then we have Paul HERMELIN, Chairman of the Board of Capgemini. And do we have our connection with China? Earlier on, it was working. Yes, hello. Hello, Mr. Justin Yifu LIN. You are Professor and Dean at the Institute of New Structural Economics in the University of Peking. You're in China. Can you hear us?
Yes, I can hear you very well. I'm so delighted.
Fine, thank
I'm
you so much.
connected, finally.
Okay.
So I'm going to start with the first question that I'm going to ask you, all of you. So it's a collective question. We were surprised, weren't we, by this increase in inflation. It was so fast. It was so worldwide. And what about if everything had been written ahead of time? If we had had wind of it beforehand? Because we were all kind of blind to it. Mr. Trichet, what do you have to say about that? Thank you very much, and thank you very much for the invitation. Thank you. It's lovely to be here with so many friends. So first and foremost, yes, the surprise was huge. It was a huge surprise, as Jean-Paul was saying. Jay Powell, the head of the Fed, was saying at the end of last year that inflation was transient. And here we had 2% of inflation in 2022. That's what was thought. It was based on analyses and the model of the Fed. So the surprise in Europe was huge. And I will just give you the multiplication of the underlying inflation, the core inflation in the jargon. So within a year, we went from 0.9% in the Eurozone to 4.6%. In other words, that's a multiplication by a factor of 5. So that just shows that something very powerful has happened. And now on both sides of the Atlantic, we've got 8.6% of deadline inflation, and that was in May in the United States, and in June that's what we had in Europe. So to explain the effect of surprise, as Jean-Paul said, there was this feeling that there were no more problems of any kind. We had the same feeling with the moderate decades before the subprime crisis and what I experienced at that time. So we've made the same monumental error. So when we see that interest rates are very close to zero all the time, you know, you've got to be very wary of such trends. There are many reasons that can explain what has happened, and this is my concise response to your question. Before the war in Ukraine, why have we observed on both sides of the Atlantic, as Jean-Paul has said, in all advanced countries, why have we seen this explosion in inflation? First of all, you've got the end of COVID, you've got supply and demand, together creating an inflationist situation which should have been anticipated but was not. Then you have monetary policies, very commodity-based, not just because of COVID, but since the Lehman Brothers event, because of there was the materialization of inflation, the inflation risk that was feared by all central banks on both sides of the Atlantic and more generally in all advanced countries, justifying ultra-accommodating monetary policies, budgetary policies that were also very much accommodating. Larry Summers said, long before the war in Ukraine and long before the end of last year, he said, be careful, the budgetary policy is going to create a lot of inflation. And today, you know, that's what's happened. And he was right about it. So that was the third reason why that's where I see a real cause of inflation. Then you've got deglobalization. I think there's a real phenomenon there. Re-examination of world value chains, the vulnerability of these value chains. That's what we're seeing. You know, any guarantees against disruptions to these chains. Then there's the green transition that's really increased the investments to be made. And then there's this inflation aspect that is underestimated, I would say, with this green transition. That, you know, we've got the real interest rates going up in the world, and at the same time, the Central European banks have to manage a different monetary policy. So that's why we have bigger interest rates. Now, perhaps there's a specific Chinese problem again. We'll hear from our Chinese colleague about this, a production problem, and of course China plays a major role in the world. So all of that was before the war in Ukraine, and of course we observed that inflation was going up in Europe, in the United States, in advanced countries before the war. Now the war, of course, accelerated all of that, prices, agricultural production. There was a loss of trust at worldwide level, which was very serious. And of course, that led to inflation. And then I can add that Europe, unfortunately, it was especially struck. Europe is the weakest link. Europe it depended most on supplies from Russia. So Europe is there in the center of the war. And comparing the United States and Europe, we mustn't forget that we have been more impacted than the United States. So I think I've taken up my time. Yes, you've even used up a bit of the time of the next speaker, but thank you very much for answering that question. So same question for you. Yes, thank you, Béatrice. I'm going to start by saying that I'm not happy about the title. I want to break inflation. I come from a country, Brazil. Our memory is much more recent than the memory of Europeans with respect to the inflation processes. So it makes it reduces salaries. It has an impact on future investments. It disrupts a whole lot of growth factors and distribution factors in the economy. So it's not managing inflation; it's breaking things. But the good news is, and I really believe in President Trichet's analysis. We've got the right tools. We've got central banks, and we can debate about the fact, you know, with the different paces, whether we're behind or ahead. But I think we have to trust the technology that we have. We've got our monetary policy, the analyses that we have, and the political leaders and decision makers we have, because it's not simple. Myself, as you know, President Trichet, President Trichet, you're a good example of this. There's the timing of the monetary policy. It's something that's quite complex because we have to break inflation, but as Jean-Pierre was saying at the beginning, we have to do this while at the same time maximizing opportunities, so that if you're breaking inflation, you do this in the most favorable manner possible for activity. It's not easy, but it's about you know, transmitting sector-based shocks, sharing them across the economy. That's what triggers the spiral, and that's what triggers the inflation process. Now, this, you know, process where we're moving from something that didn't exist and we're moving into anticipation, that's something that we have to break so that we can manage the inflation process. It's not just a question for banks, it's everybody's problem. Inflation is the most regressive tax that may exist. Countries that have high inflation rates, like developing countries, they know this. And I will finish with a small observation about your remark about green inflation. So perhaps it's a paradox, but we had an adjustment, a relative price adjustment. I think it's Christine Lagarde who mentioned fossil inflation. So this already took place at a level that we no longer hoped would be possible with the carbon tax. We were expecting for Godot, and something happened that is perhaps, yes, that's something that has to be managed, I agree, but inflation has to be broken. But the alignment process, the incitation of this relative price change between the fossil and renewable, yes, we have to manage it in a virtuous manner in order to accelerate the energy transition. That's a very complicated question. I think we'll talk about this question in many other auditoriums, but I will hand over now to my colleagues. Thank you very much. Jean BEUNARDEAU. Yes, I looked at inflation from an historic point of view to see whether we were in the conditions and to look at things and see whether anything had been changed. All monetary stability periods have been followed by quite strong inflation. Jean II, who was a king of France, he created the franc, which was a reserve currency, and it weighed 2.7 grams. And it went together with an account and pounds, and there was a great defeat in Poitiers against the English. Now, the value of this pound, which became a franc later on, was divided by 150,720. So inflation, it's not just a phenomenon that is new. There are many historical periods of inflation. There are three causes. First of all is the inflow of settlement currencies. This is what we had in Spain of the 16th century with the gold and silver from you've got expenditure, state expenditure to finance wars. Now that's what we had in the 13th century. It's China as well, because there was the bank that was created. Then you had the Regency in France after the War of Secession in France, the two World Wars and the Vietnam War for the United States. And the third is the terrible drop in supply, like with the Great Plague of the 15th century, or the petrol crisis, the oil crisis. Now, these causes can all join together. And of course, as President Trichet says, that's what we're seeing. We're seeing an accumulation, and it's monetary creation that created fertile ground for inflation. The catalyst was COVID and the war in the Ukraine. Now, could Could we have said when it was going to happen? Well, not easy to say, because we knew that we had to observe the excess monetary creation. But when was it going to happen? It depends on behavior in terms of savings and demand. Paul Hermelin, same question for you. After what's been said, and without going back down history like Jean, let me just make 2 or 3 remarks. The first is that, well, we're heading towards an era. There are several types of inflation, and we can't use the same remedies. We won't succeed with that. Then we've got demand and supply, and as Jean-Claude says, we've got the COVID measures, Trump's COVID measures, flooded the market, created demand, and so we had this excess of demand with respect to supply, and this increased prices, and that's only can be treated by compressing demand. So then you have external inflation, like with oil and raw materials. It's not quite the same thing. First of all, we have to underline that there was external de-inflation. Europe was virtuous for 10 years. We hadn't had any inflation. But low inflation was the sum of external de-inflation coming from globalization that was very dynamic, and then a certain internal inflation because of the mediocre competitiveness of services. So it's the balance that was at zero. Believing that we were virtuous everywhere across France or Europe, that's just a mistake. So for a while now, we've lost the driver in terms of inflation. And then you had COVID with the freeze in international trade. But whatever the case, there was a refusal for de-inflation because of products coming from China. So getting rid of that driver, this de-inflation driver, meant that the balance was no longer zero. It became positive. So it's something that will have to be dealt with. And you mentioned, well, you told me to talk about sequences. You've got the question of oil. Some people are happy that with the Ukrainian crisis because it's brought fossil fuel prices up. Because of and that has an effect on carbon taxes. Now, I've heard from different company heads. As of April and May in 2020, right after the lockdown, they told me there are supply problems. Prices are going up, and we're not going to be able to keep on track. Now, central banks didn't really want to take that on board, but because there was this external de-inflation from globalization and the increase in prices of raw materials, this was independent of the Ukrainian question. So, Mr. Lin, can you hear me? We're very interested to know what your point of view is for the question.
Okay, very good. The good news is that inflation is not an issue in China, because we can see the CPI in China in the first quarter this year was 1.5%, and in April 2.1%, May 2.1% again. Most likely, the second quarter, the inflation rate in China is likely to be 2.1%. And for the third quarter this year, the projection was 2.6%. The fourth quarter this year, it was 2.3%, the forecast. And for the whole year, the inflation rate is likely to be 2.1%, extremely low. And not only the inflation rate in China is low, China is contributing to the mitigation of high inflation in EU, in US, and other countries. Because production in China is not much affected by the COVID-19. And so the production continued. And when other country was hit by high inflation, that means the demand in those countries are larger than the supplies, and China can export to fill the gap. And it was demonstrated last year. The trade surplus from China was 676 billion US dollars, about 3.8% of China's GDP. And in the first 5 months of this year, the trade surplus of China was 300 billion US dollars. So China export more to the global markets than import from the global market. And those net export certainly will contribute to the lowering down of the inflation rate. So that means what? Without China's export, the inflation rate in EU and in the United States, which would be much higher than what we observe now. And looking ahead, next year and beyond, China is likely to maintain low inflation rate because the inflation rate in China since 2012 has only been between 1% and 2% every year. And the main reason for that was because the growth rate in China decelerated from more than 10% before 2011. Before 2011, the growth rate in China has been, around 10% or more every year. But since 2012, the growth rate in China has dropped down to now around 5 to 6%. That means there is large excess capacity in China due to the lowering down of the growth rate. And because of excess capacity in China, as long as there's excess demand in the global market, China can increase the production, increase the export, and those export will contribute to the mitigation of high inflation in other countries in the world. Let me stop here.
Merci beaucoup. Donc,
China is part of the solution. Now, is it part of the solution in medium term? I wanted to ask you the following question now. Jean-Claude TRICHET, are we now, I mean, you provided a partial answer, but in a new world, in a durable way, higher inflation, higher than this kind of a current situation, which happened 20 years ago with the entry of the China into the World Trade Organization, or in view of what you mentioned, transition? Well, first, let me say that there was an interesting, important phenomenon at the time of the Lehman Brothers crisis. All central banks of developed countries gave themselves the same definition of price stability, that is 2%. It was the European Central Bank before. It was the case before, after correction from the Bank of England, and after Lehman Brothers, the US and Japan, in that order, adopted the same definition of price stability. All major central banks of advanced countries whose currency are in the special basket are the same definition of price stability. And in the current period, which is clear inflation-prone situation, the Fed confirmed that it will lower when it comes to the inflation anticipation. Inflation is around 2%. Indeed, the European Central Bank just said it quite strongly, and the other main central banks too. So clearly, the central banks now want to say we maintain our definition of price stability, as I said, or objective of price stability, as some of them say. Now, basically, I trust that we are not in a period of very high lasting inflation. I think we are going to go back to what I experienced myself. I could go to Berlin proudly and say, since the beginning of the euro, at the end of 2011, we've had a mean inflation of 1.97%, something like that, totally in line with our definition of price stability. I do trust central banks to give us, in the medium term, medium-long term, the price stability in line, in line with their commitments, which are public commitments. Of course, they're not alone, and we need that all other partners and players take into account the fact that we are in a world where the threat is more a threat of inflation in advanced countries and global, but not a threat or threat or risk of deflation. We've changed the nature of the threat, algebraically speaking, but I remain confident in our ability to preserve our price stability, which once again has a global definition and not just European. So, eventually, Mr. Trichet says price stability is 2%. Why? Medium term. Why not 3, 3.5, why even 4? Well, to answer, and I fully agree with President Trichet, when we look at the inflation anticipation 2024 for most of the major monetary zones, we converge around 2%, which is the objective for the price stability. Therefore, central banks trusted we trust central banks to do their job. You know, they're convinced that this work will be done. This is great news, and it is also progress that have been made in the targeting the independence of central banks, where they were able to create the great moderation. Don't forget, we went to, for about 30 years, in inflation, low inflation, which created growth and well-being. So clearly there is a whole set of good news. And as I was saying, I think that central banks are able to break inflation today. But I believe that it is also true that there are risk factors. President Trichet early on talked about the fact that the objective of carbon zero, net zero carbon in our economies, which is a major objective. We all noting the effect of global change. Well, this will call for technological investment for a certain amount. Actually, as we know, this investment will be huge. I mean, well, we don't have to see this not as a disaster, but in a Schumpeterian approach. In the Rencontres, we got Philippe Tréjean, who will talk about virtuous growth, and Jean-Claude talked about. So what are the means to be mobilized to ensure transition will take place towards a low-cost renewable energy transition? This is to be examined. This is, in terms of inflation, it will increase. So, but when it comes to the change of the geography of globalization, so we'll have to do, we look at the cost of with the new geography of different geography of globalization, and this will have an impact on cost, of course. And another point that we have to acknowledge, what Jean-Paul talked about earlier, the redistributive conflict. But it's not just in Europe. I mean, we realize very well that if we pay attention to our representative democracies, if we are able to analyze the fact there is a fact between redistributive conflict and the rise of populism, well, we have to question the fact that at one given stage, we will have to think together, conjointly, and achieve a consensus about the way today salaries, wealth is shared, profits and salaries. So it's quite compatible with growth, better productivity, but will make it possible to relieve a bit what is an underlying cause of the transmission of cost towards inflation, which is the tension of redistributive conflicts that in the third world and in different countries we know very well. And I think today we are re-experiencing in a stronger way in advanced countries, but we have to think about it, and we need to find a solution which is socially just and which will achieve a political consensus. Did we enter a new world? Well, I think to look at the topic, we have to look at the production factors, and monetary policy. I'm not as pessimistic as my co-panelists as to the structural factors, because I see three that drive inflation up and three that push inflation down. The three up: energy, cost of energy, especially with energy transition, the increase of expenditures of safety, homeland security, diverse regulation, which structurally will increase the operating cost of the economy. And there is also an arbitration in many domains of the economy, more in favor of margin than volume versus what happened in the past. It started before COVID, it was pushed by the shortages, and it will last a while. However, on the contrary, the shock, the raw material shock, are always followed by counter shock, regardless of the material and the period. The cost of raw material always end up dropping. The internet distribution, the economy, you know, the fight against inflation, the internet contributes to that. And you know, there is a factor of inflation. Even if we got a problem, we understand sometimes that this new economy contributes to that. So depending on the monetary policy, as that was said, and in fact, the monetary zones which do not manage inflation paid rapidly, you know, pay the cost with exchange rate, as we see between the dollar and the yen. Now, the economists do talk a lot about cost salary loop. Is this something to be feared, to be anticipated on, or organized? No, a lot of managers talk about that. I believe that it is the topic of summer 2022, because as of the you know, in September, this will be the key agenda, and the loop or salary adjustment loop will be considered as of September. First thing, let's not ignore. We should not ignore the result of the two elections we've experienced, and this will lead us to a rather confused or unclear political situation, and we have a very combative left leader, and we have to consider this could generate from the French government, you know, they would want to appease strikes through increased salary, and businesses would say, instead of going through strikes that are going to be harsh or hard, well, let's readjust salaries. I'm talking about NAO 23, you know, mandatory annual negotiation, that would 23, which will be anticipated in summer 22. This is the outcome of those election cycles, and we have to bear that in mind. This is very specific to France. Is it serious? Well, if it leads to a permanent cycle, it is serious. But we are at the critical point. Now, two other comments. We did talk about the combination between salaries and you know, the great resignation wave. You know, I'm in the domain of technology, consulting. We were actually impacted by that, but according to the young people, we apply usually young employees. You know, usually mean age is 31. People talk mainly about the meaning, and following the crisis of COVID and the existential shock they got, they want a job that has a social meaning, social in terms of societal meaning, in terms of climate, diversity, inclusion. So meaning and flexibility from the young employees. I don't hear about inflation or cost adjustment, and that they want sense and flexibility. The other point I want to mention is about salaries, and this is the topic of the fall. Well, the government will increase public expenditure. You know, 20 million euros for the purchasing power. What's the ability of public authority of the nation? Whatever the cost, you know, what will it be? 22, 23, 24. Public expenditures will limit pressure on salaries, but this will have a cost, an impact on the debt that you know, could be scary in itself. So the third point I want to mention, and I'm referring you to to something mentioned by Jean-Claude Trichet and by Mr. Pereira on the income policy and expenditures. Well, I do happen to be a young dinosaur. I'm a young dinosaur because I was in Jacques Delors' team in 1981 and 85. The key to prevent price-salary linkage, it was to project ourselves forward, because if we try to solve the, it's called scala mobile in Italy, you know, the mobile scale that exists in Belgium still. You solve the past inflation, and the managers, business managers, try to impact it on price, and you go, the merry-go-round goes for another spin. So Jacques Delors' talent, not to ignore it, was to have, well, to get to a situation where political power, managers and trade unions, you know, could actually commit themselves. There was an advertising spot, if Jean-Claude remembers, with a selling board, and the France was behind with a selling board where there were the figure 13, because we had 13% inflation, and there was a race, you know, and we had recurrent. And so the anticipation was to go to 8. The inflation objective was to go from 13 to 8% by managing an agreement between employer and employees to go to 8, and then 5, and then 3. Now, in order to pull out of the price-salary cycle, we have to shift to anticipation, looking forward. If you're not looking forward, you'll never make it. There you go. So this is exactly the situation we face, because if indeed central banks are able to anchor anticipations into a 2% convergence in 2024, it is quite possible to recreate the virtuous condition you mentioned, that is the ability to have a coordination between central bank policies, monetary policy, budgetary policy, and the way anticipation for inflation will be anticipated to lower with businesses. I'm not saying it's something simple to do. It is highly complicated, but it was done. Another experience of, you know, Israel and Michael Brunel, you know, the governor of Israel central banks in the 90s, with inflation which was much higher than the European one today. The tripartite agreement between unions, trade unions, private business and government were able to create actually this green virtuous trajectory of the drop of inflation through permanent anticipation. Beatrice, if you don't mind, then we'll give the floor to Beijing, to Mr. So do I remember it? Of course I do remember the Delors period and the a priori indexation and not a posteriori, but also the fact that this concept, very concept called competitive disinflation, was continued by France for 17 years with several successive governments of different views, and the success was brilliant. There would be no euro. We wouldn't talk about the euro if we had not had this multi-party policy for 17 years. Mr. LIN, can you hear us?
Oui. Vous nous avez dit en
Yes,
présentation.
I can hear part of your argument, but sometimes it was silenced, so I cannot keep track all the argument from my side.
Ah. Vous nous avez dit en préambule que
For
l'inflation, c'est
example, I
pas un
cannot hear
problème.
you now.
Can you hear me, sir? Can you hear the translation? Hello, can you hear me? No, I think there is no. Sir, can you hear me? Can you hear the translation, sir? Can you hear the translator talking to you now?
No voice, I cannot hear you.
Yep.
Sorry.
Well, let's see if we can get the connection with China. So we started talking about some of the solutions. Well, what central banks can do, what states do, you know, the purchasing power law. Now, central power. Now, don't you think there could be a risk? We in the eurozone we are 8. You said that the medium-term target is 2. Don't you think there is a risk of overreaction of interest rate that would cause precipitate or accelerate inflation? The fine-tuning of central banks will be complicated in the coming months. Of course, indeed, there depressive and inflationist effects, and we have to take both into account in your medium-term perspective. Central banks are independent and they can reason in medium term. They commit themselves in medium term. So we can see clearly that in the US and in Europe, the provisory conclusion of central banks that I have to preserve my credibility. I said that I will achieve inflation around 2% in the medium term. I can prove that I'm credible by acting myself. And in the US, you saw that after having said there will be no inflation, we don't move. Now we going through the third inflation interest increase crisis. So Christine already said that we will get an increase. Many experts actually, waving the red flag and saying there will be inflation. Well, there could be a risk of recession, but they're not right to say it is the monetary caused by the monetary policy, because this monetary policy today is far more accommodating than before, because the nominal interest rate haven't moved yet. I mean, those of the central banks in Europe, whereas the real rates short term have dropped significantly with the inflation. So what counts for central banks today is to remain credible. If they lose their credibility, everything is gone, because we cannot anchor inflation anticipation, as what was said, and then reassert, because we are in a turmoil, in a 8.6% inflation, red line in Europe and in the US. I'm not talking about the core inflation, which is in the US it's at 6%, and for us it's 4.6%. So in both cases, if you want, there is urgency. Central banks are right to say that we act on our side, and I believe that they are absolutely right to say, careful, we are not alone. We're not alone, and the second round effect could be essential. For example, there could be tragically anticipated by the social partners and the governments, or even the parliaments, or they can be denounced as being high threats in medium term. Now, if we lose the control of inflation, we know what we're going to get, because we saw in the US what it means to break inflation when in a high advanced country, Paul Volcker comes back to monetary power and commits necessary action, but quite dramatic, with interest rate at 14, 15, 17%. We don't want that. We don't want that. And this is why the US and the Fed and the Europeans and the European Central Bank are right to say, don't forget us, we're here and we act. And we act without listening to the good advice of those who said, do not move. If they are not helped in the two sides of the Atlantic by the governments and the social partners, and then we'll face a very, very bleak situation. Mr. Da Silva, how high could the interest rate rise? I think President Trichet summarized the situation. You don't want to enter in a high inflation zone that would be permanent, that would spread to the entire economy. Let me give you another Brazilian anecdote. In a high inflation period in Brazil, if you wanted to go from one point to another, you pay the taxi the arrival and not at the start, like the bus when you have to pay at the start. So when you go low income and distribution of income, so action of central banks, of course, and action and as long as necessary. The dosing problem are technical problems. Central banks are quite equipped to calibrate their monetary policies as a function of the offer and supply, demand and supply condition. They have a great experience in this domain. They have the tools, appropriate tools, and they do, and I think President Trichet is quite right, they must have two independent ways in their role, but they have to rely on other players. And when the recession problems will occur, we'll be able to trigger compensatory policies for more vulnerable groups, unemployed people and low-income revenue.
Yes, Jean Bernardeau. Yes, I would just add a point. The central banks don't just have rates; they have the message, and That has already changed the paradigm, the monetary paradigm. First of all, they've broken the perception that the markets had, that the monetary policy had deleted the moral aspects and the excessive leveraging. And they've talked about the dynamic of permanent growth and the price of assets, which is a factor that's promoted by very low interest rates. So this new paradigm is less financial. It reorientates part of the forces of the economy, more innovation, work and productivity. All of that must allow us to find a path without bringing the rates up too high, a way of managing inflation without breaking growth entirely. So we heard about the central banks, but what about states? What's their role? We've heard about prices being blocked. We've heard about VAT being decreased. In France yesterday, there was a law on purchasing power that was announced with a policy for protecting people against inflation. What about the state's response? How can it be calibrated? What about the risks? So you've talked about different paths there, different problems. There's a first point that we have to be wary of. It's something that needs to be explained, especially in French, and that is the pernicious effects of price blocking. That leads to terrible inefficiencies in the economic system. This doesn't mean to say that we can't ask people in energy to make an effort with prices. But if the state starts to regulate prices, then it is powerless be in front of production here. It leads to de-optimization of the economy. There are the political forces talking about this. We need to all be clear that signal is an essential signal for optimizing the economy. That there are effects that have to be compensated in different ways. We've talked about fuels, but the idea of a complete blockage is the wrong idea. And the second remark that I'd like to make, the compensations, with the idea that states are trying to target instead of sharing out, and we think about the underprivileged, we need to give money to the underprivileged. This is perhaps what states do in a very national context. There's no agreement, no concert. I don't know what the European Council is doing. Do people share the data of their programs for preserving purchasing power? It's almost as if the European Union doesn't exist, but we have a monetary union. Nobody compares what's happening in Germany or Sweden, the Netherlands, France, Italy, Spain. And so there is, the states have a role to play, especially when it comes to the underprivileged. And this is what you're underlying. Inflation is a tax for the underprivileged. And so there is room for the states to act. There's also a need for talking about it, agreeing about things. We need some kind of benchmark. And I'll finish with what Jean Bernardo was saying earlier on. There's a point which is really the key to the exit. We mustn't interrupt productivity. The risk is far, even if the rates are going up, the real rates are still negative, but we mustn't cut investment or cut productivity. We talked about Schumpeter, we've talked about innovation. The exit path is to focus on innovation in European economies so that we're making the right decisions, so that we're not just focusing on purchasing power and demand and sacrificing future programs on integrated circuits or the hydrogen program. We need to find the right balance between future investments and defensive measures, and notably for the benefit of the most underprivileged. So somebody is looking at me. We're already over time. So our speakers will be staying here, but we really must leave the stage now. So you can ask the speakers later. Maybe, Jean-Paul, you can give us a 15-second conclusion. Yes, 15 seconds. Okay, so the first session. So I agree with Luiz. We shouldn't have called it managing inflation, but controlling inflation, rather than breaking inflation, but you want your breaking. Oh, well, too bad. So breaking inflation. The second thing is that central banks, as well as income policies, should help us with this task. And there's something else that Mr. Bernardo talked about. It's true that the best solution is really to have a higher growth cycle. That's the only way in which we will be able to agree about the way to break inflation. Thank you very much.
Parle, d'accord?
Oui.
Et tu veux faire un aparté. Tu traduis l'anglais.